You're listening to Let's Talk Macro.
Brought to you by Bandhan Mutual Fund.
Hello. We've caught you just in time as May is about to end. We're back with another episode of Let's Talk Macro, the podcast on macroeconomics by Bandhan Mutual Fund, where, as you know, we discuss interesting global and domestic macroeconomic topics and events. Who's the we? That's me, Ahalya, and of course, Sreejith Balasubramanian, economist in the fixed income fund management team. Welcome, Sreejith. How are you doing?
Thank you, Ella. I'm good. How are you?
I'm very good, and we do have cause for celebration because we've just notched a little bit of a milestone here on the series, Sreejith. Congratulations to you and to our entire team behind the podcast effort on a monthly basis because, we got recognized at the annual Golden Mike Awards in the Best News Podcast category, and it's been such a pleasure just enjoying this ride for the past couple of months.
Yeah. And thanks to all of our listeners.
100%. And no podcast is anything without its listeners. So let's dive into this one where we continue to give our download on the latest macroeconomic developments. Now, in the last few episodes, our discussions have mainly focused on global macroeconomics, right? There's been a lot of action, particularly in the US, and it has been a while since we discussed India, our home ground, in some detail. So in today's episode, we're going to do just that. We've got to talk about economic data in India, the fiscal and monetary policy context, our global linkage, and what this implies for our cyclical and structural economic outlook. So to set the context for our discussion, Sreejith, could you tell us first about how domestic economic data is currently looking?
So, economic data in India has been holding up quite well, despite some moderation in certain areas. Firstly, inflation has been easing. So, CPI inflation eased to about 3.2% in April from the recent peak of 6.2 in October. So, this sort of reflects an increase in purchasing power. So, the real wage growth, so that is the nominal wage growth if we adjusted for inflation in rural India, has been moving up. And Rabi season raw procurement is the highest in the last 4 years now. The southwest monsoon season outlook, although still early days and a lot depends on the eventual spatial and temporal distribution of rainfall, is looking good at this stage, which augurs well for the Kharif season rice crop as well. Increase in currency in circulation recently, also has been a bit higher. So that's it. Industrial production of consumer non-durables and two-wheeler sales have remained modest. So rural, particularly the agri side, seems to be getting better, and related consumption indicators are also sort of holding up again. But investment and manufacturing indicators have some scope to improve. PMIs, the purchasing managers indices, for instance, they remain fairly strong, but they've been flatter of late. Credit growth, we know, has been moderating. So overall growth data is holding up, but there are areas with some moderation. And as we have spoken before, we know the global outlook is volatile and looking milder.
Yeah, okay. So data is holding up, even though there has been moderation in some areas, and the global outlook continues to remain volatile. Now, coming to our domestic policies, let's start with fiscal, always an important point of discussion. We spoke about, how after the union budget, the government's deficit targets, right, have been looking. So what is the state on that currently?
The central government targets 4.4% of GDP fiscal deficit for the year ending March 2026. And we recently got to know the RBI surplus or dividend amount of rupees 2.7 lakh crores or 2.7 trillion that is to be transferred to the government. Now this is probably slightly lower than what the market was expecting, although it's higher than the budgeted number because the contingent risk buffer, the CRB that the RBI sets aside was increased from 6.5 to 7.5% this year. So that means if that is global economic volatility recedes next year, let's say, hypothetically, and the buffer, can be adjusted lower, the surplus amount could possibly be upward accordingly. So what I mean to say is there's some sort of smoothing out of the surplus amount in a sense, but entirely depending on economic conditions. Otherwise, corporate tax revenue and expenditure estimates are quite realistic as we spoke about after the budget, although we'll have to see how economic growth evolves from here. Income tax revenue growth estimate was probably a bit on the higher side, especially given the tax cuts that we saw in the budget, and disinvestment strategy needs to be really worked on. The other question now is, given the drop in crude oil prices and the sort of benign outlook there, whether the government can hike excise duties on fuel to some extent to garner some revenues there. Therefore, seems that even if there are mild misses in revenue or expenditure targets in the FY26 budget, or if growth moderates and some stabilization is needed, the central government fiscal could still be on target. And after FY26, we know there's a clear debt to GDP based fiscal trajectory with a 50 plus or minus 1% debt target by end of FY31, the end of the next 5 years. Even there's space for some limited degree of short-term cyclical fiscal response.
Okay, so higher than budgeted RBI dividend and potential space for some excise duty hikes do imply that fiscal could still be on target, even if there are mild misses in revenue or in expenditure. I guess that puts the central government fiscal situation in a fairly good place for now. As we know in macroeconomics, for now is the operative word. But let's move on to monetary policy. We've previously spoken about RBI's liquidity infusion, right, Sreejith? So given the moderate inflation situation, what is the outlook for monetary policy?
Yeah, so as we discussed, CPI inflation has eased. In April, we had negative sequential momentum in cereals, vegetables, pulses, and spices. So that's within food. And therefore, the outlook for food inflation is also quite benign, given the good rabi wheat crop and the expectation of a good monsoon. In our previous episode, we discussed the weakness in the US dollar and why it could sort of drag further. And this essentially implies easier financial conditions for emerging markets like India, and therefore less worries about the rupee. Now, given the milder global growth outlook, oil prices have also been coming off. There is also the possibility of exported disinflation from Chinese goods. Overall, the outlook for core inflation, which is currently at 4.1%, is also looking good. In terms of policy action, the RBI has cut rates, changed the stance from neutral to accommodative, and proactively infused permanent liquidity through OMO purchases worth around 5 lakh crore plus, and even through FX swaps worth around 2 lakh crores plus. So therefore, we estimate core liquidity is currently above 6 lakh crores. So the focus of the RBI is clearly now on effective transmission of rate cuts, despite the RBI likely settling some of its outstanding short USD forward position. We also expect 2 more rate cuts in this cycle, which will take the repo rate to 5.5%. All in all, we have a very proactive RBI with ample liquidity, rate cuts, and above all, unambiguous policy guidance. The weaker oil and dollar environment also allows the central bank to therefore focus on domestic economic priorities, including growth.
Yeah, so I mean, a pretty proactive approach there. And you spoke about the fiscal and monetary policy trajectory and the outlook for, the next couple of weeks, months. So how do you think the uncertainties on the global front could impact India, Sreejith, especially given the US trade policies, the frequent changes in tariffs? I mean, everything we've already talked about.
Yeah, so India is not insulated but lesser impacted from global volatility, I would say, given the moderate trade and capital linkages in general. Direct impact from US trade is also small. So, for example, the share of exports of goods and services in our GDP is around 21%. That of imports is around 24%. Therefore, the total trade to GDP is around 45%, which is lower than some of the other emerging markets, particularly if you look at some of the export-focused Southeast Asian neighbors. Now, trade surplus with the US specifically is only around 1% of GDP for India. So the impact from global volatility is likely contained. But we'll see the impact of policies in the US, be it on tariffs or fiscal. That will naturally happen through currency and interest rates to some extent. Indirect impact will be through the effect of these policies on US growth and the broad uncertainty it creates. We've spoken a lot about it before. And if you look at the direct foreign share of holdings in our GSEC outstanding, that is also quite less compared to other emerging markets, which is, again, another buffer for us.
Yeah, so likely quite a benign direct impact, particularly on trade, given our global linkages. Now, the final question that this brings to the podcast, Sreejith, is the structural Indian story that we've discussed before. Where are we on that now? What is the outlook on that front, given these global aspects as well?
Our structurally bullish view on India is primarily based on the pillars of a downshift in the current account deficit run rate due to higher services trade surplus, and also continued credibility of both fiscal and monetary policies. Fiscal consolidation, better expenditure quality, accounting transparency, and even clear guidance have been the hallmarks of the central government's fiscal policy in recent years. And I think we've spoken about that. a credible, flexible inflation targeting framework is again the cornerstone of our monetary policy. Therefore, our view remains intact. We don't see a major risk of meaningfully easier fiscal policy, which sort of derails it off the trajectory of consolidation and hard-earned credibility. In today's context, even fiscal policy is consolidating. Monetary policy has more leeway, and this is being utilized rightly. Also, it is important, we separate the structural and the cyclical economic factors. Quickly, as we discussed, again, the domestic inflation outlook is favorable, and the weakness in the US dollar could drag. There could definitely be some impact from US policy. Even there, lower growth in the US could offset the rise in long-end rates seen in the near term due to the possibility of further easier fiscal policies there. Also important to remember the foreign share in our G sectors. And like you just mentioned, it's only around 3%. It's quite low. And let's also not forget, we are now the 5th largest economy. In fact, probably the 4th largest in 2025, overtaking Japan in terms of nominal GDP. So quite some potential there, and therefore our structural view remains intact.
Yeah, I think it's always good to refresh the fundamental aspects behind the structural view. And as you rightly pointed out, separate the structural from the cyclical, given the number of changes we are contending with on a daily or weekly basis, right? Well, as we come to the end of this episode, it's time for a quick summary of the key takeaways, so everyone pay close attention. Number one, domestic economic data in India is holding up pretty well, and the outlook for the rural space is good, although the monsoon is a major factor here. That said, there is some moderation in other areas like manufacturing, credit, and so on. And the global outlook is still volatile. Point number two. Central government fiscal policy will likely be on target in FY26, even if there are mild misses in revenue or expenditure, because RBI dividend was expectedly higher than budgeted and the oil price outlook is benign. Beyond FY26, we have a debt to GDP based guidance. Meanwhile, we've got a proactive RBI which has cut rates, changed the stance to accommodative, infused permanent liquidity to focus on rate transmission, and the outlook on the US dollar, crude oil, and domestic inflation also don't seem worrisome for now. And finally, India is likely to be less impacted from global volatility given its lower trade linkage, but there will still be some impact through indirect channels, the uncertainty from US policies, and therefore financial flows. However, India's structural story, driven by low CAD and credible fiscal and monetary policies, despite any cyclical impact, remains intact. That's it for today. I hope you found this discussion useful. Thanks so much, Sreejith, for joining us as always and taking us through the ins and outs of the global macroeconomic space. And good to focus on our home ground a little bit, give people a picture of that.
Yeah, it's been a while we spoke about India, so good to catch up on that.
Yeah, and I'm sure we'll have another interesting conversation next month. We'll be back with another episode of Let's Talk Macro. Until then, bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.